Welcome to the Rose Show podcast. Today, I'm so very excited to be here with Chris Versace, CIO and founder of Tematica, leaders in thematic research and investment strategies. Chris, you're also lead portfolio manager for the Streets Action Alerts Plus portfolio. You've also been co-author of a great book, Cocktail Investing. You are a contributor to too many publications to even name here. And you're also a speaker and frequent guest on TV. Did I miss something?
I'm pretty tuckered out after that intro. I don't know how I do it all. I got to be honest.
I was going to ask you how you find the time to even be here today, but I'm so grateful that you took the time in your very busy schedule to be here. So how are you doing today, Chris?
You know what?
You muted yourself.
Sorry about that. I meant to blow something up so I could see you better. What I was saying is that so yeah, I'm in a very good mood. It's we're in the kicking off on earnings season. We've got a little bit of lull here, but it's a beautiful day out, and I'm always happy to talk with folks about thematic investing and stocks in general. So let's do it.
Sounds great. Thank you so much. I'm also very excited to learn more about your thematic investing, which, as I read your website, resonates with me completely. So let's begin with the pink elephant in the room. Tell us exactly what is thematic investing?
It's a great question, isn't it? So, there's a lot of folks out there who talk about thematic investing, and they all have their own little twist, if you will. I kind of get my back up at some of it. More oftentimes than not, what is put forth as thematic investing is more like niche investing, micro slice investing, or something like that. So the way that we define thematic investing is we're looking for structural change. And how do we identify that? By the shifting landscapes of economics, demographics, psychographics, which has to deal with the consumer, technology, and some regulatory mandates. And the way we kind of see it is, what are all investors looking for, right? They're looking for outsized gains. In other words, alpha generating investments. So how do we do that? Well, if you can identify the right structural changes and then identify the companies that are poised to prosper from those changes, i.e. have one or multiple tailwinds pushing on their businesses, what do you tend to see? Outsized revenue gains, EPS gains, favorable cash flow. That is one part of the recipe to great stock performance. The other part is multiple expansion. And when you get those outsized margin expansion, EPS gains, you tend to get that multiple expansion. So expanding multiples, rising earnings, higher stock prices. So if we can do our job right and identify the right thematic drivers, we believe we can help identify companies that are poised to do very well over the medium to longer term.
Sounds great. Now, I know that when we talk about the thematic investing, it's not about trends per se. And a lot of people use that word about looking at the trends. So could you explain the difference and how you see it between the trend and the actual structural changes that you see occurring in our economy and in the business models?
Sure. So the best example is probably a trend of Beanie Babies, Cabbage Patch Dolls, or fidget spinners. They're all very short-term phenomena, right? There's no longevity to them. When we think about structural change, these things tend to happen over multiple years. Again, going back to demographics, psychographics, or even technology. So we look for long-lived structural changes. That's probably the cleanest way that I can explain it. But in terms of examples, let's think about what's happening in the US and in other countries around the world with their aging population, right? That is one of our investment themes, because that is a huge structural change that has significant impacts across many aspects of the economy, right? Everything from the size of the workforce to the healthcare system to how we're going to care for these people, right? In terms of where they're living, the services that they need, how we do that. So that's one example of it. But another that we have an ETF in Europe with our partners, with one of our partners, is digital infrastructure. And to me, that's one of the more fascinating ones, especially in this day and age and on the back of the pandemic. And I say that because, we all have, these devices, right? And we stream and we do all these different things. We communicate through social media, email, messages. This will be posted on YouTube, I believe, Ro, so people will consume it there. So what happens is we've kind of weighted more and more of our life into the digital world, both personally, professionally. Companies are moving in there. Whether or not you believe in the metaverse or IoT or even AI, a lot more data is being created and consumed in above and beyond just what we think of every night when we stream shows or music or something like that. So we see constant evolution in connective technologies, 3G, 4G, 5G, and that's probably one of the greatest examples that I can give you about a ongoing structural change, because with each G, right, we get greater data speeds, we get lower latency, so that fosters new applications, gaming, and eventually with 5G, perhaps longer term 5G, autonomous driving, or remote medical monitoring and things like that. But each wave drives congestion in networks. So we see this iterative virtuous cycle. The more data we consume, the more data we create, the greater needs are on the digital infrastructure. So will there be a 6G? You bet. In fact, I believe South Korea is poised to start beta testing it in, if I remember correctly, 2028. It also means we've gone from Wi-Fi 5, 6, Wi-Fi 7. And if you look at the cable speeds that companies like Comcast, Verizon are putting out, continuing to move higher. So it's all in this push to deal with this. So that to me, like I started to say, is probably one of the greatest and cleanest examples of a multi-year structural change. And just to hammer it home, if you think back with the 2G phone, right? I'm sure, Ro, I don't want to date you, but I'm sure you know what a simple flip phone was back in the day. Probably had a StarTAC. Probably had a StarTAC, right?
Mm-hmm.
So what was the killer application? Voice, and maybe 10-button texting, which nobody did here in the States. So then you had 3G and apps started to come about, and then 4G video calling. And with 5G now, we've got a lot more apps and just far more robust app ecosystem that's creating a lot more data as we continue to do more and more. So that's the evolution that's been helped. One part of the evolution that's helping drive these structural changes. So I know it's your show, so I promise to let you ask a question.
Actually, I want to add to what you said. The Beanie Babies, and there's the spinner, the fidget spinners. To me, another word for trend is fads. They were like big, and Cabbage Patch. I remember the Cabbage Patch. I wanted one when I was a kid, and they're just fads. So you want to take more of a bird's eye view and look at the structural changes, the foundation of what's going on. And our world has been moving quite rapidly, especially in the past few years with COVID. We accelerated the whole, connectedness and work from home. Remote work has increased quite rapidly, which to me, these challenges that we had, presented opportunities. And that's exactly what you're referring to. And they're birthing new industries. And you said a wonderful word in there that I always make note of: automation. And in our business, I have several businesses, and I always love talking about this. I think this is so much fun. But we've seen a decrease in productivity. And that is key. That's one of the many challenges that we're facing. So in order to solve that, we need an increased productivity. We are birthing new industries. And I'm sure you can agree, automation and autonomous equipment, there's a big need for it nowadays. So, right? Tell us.
So two things. I think I interviewed this company, Presto Automation. They're an AI technology company targeting the drive-through fast food industry. At least that's one of their initial targets. And as I was talking with the then CEO, he shared some roadmaps for drive-through, not just at restaurants, but in other applications as well, drugstores, for example. But he was talking about how, in the next several years, you could see small form factor restaurants manned by one, maybe two people, where, you have essentially cooking robots, making the food, and out it comes on a conveyor belt. And that one, maybe two people that are in there, they're only there to manage the IT systems and make sure everything is running. They're not necessarily doing the work that we would perceive
Mm-hmm.
happens with food preparation, customer service, delivery, that sort of thing. So that's the first one. The second
Love
one
that.
is,
Mm-hmm.
I believe I read recently that Walmart is looking at really automating a lot of what they have in their stores, and that I just find that fascinating. So
Mm-hmm.
I do think that there's a theme to be had in, I don't want to say industrial automation and productivity, but I just
Mm-hmm.
think automation and productivity. And I think
Exactly.
there's a strong narrative around that,
Mm-hmm.
given some other themes that we have. I just touched on aging of the population, right? So, as the workforce shrinks, who's going to be doing these jobs, especially if, and I don't want to get political here, but, if we tend to have a restrictive immigration policy, what happens?
Exactly. More of a need for automation.
Correct.
I love how you mentioned the word Walmart. We all know Walmart. And, you think of Amazon, Walmart, these major companies that appear to me and to many to be leaders at this time. And it's how they adapt and thrive and survive through this process. Are they willing to accept that change is upon us, and they will adapt accordingly and innovate? And exactly what you said about Walmart applying automation is, these are the signs and the signals we need to see. Will this company remain a leader? And when companies remain stagnant and they don't adapt, they could be acquired for some of their technology or other resources they have, or they fold. You on your website talk about this, how their company has just faded away. And and then we see others that are able to adapt and innovate can remain as leaders, and then there's room for emerging leaders. These are obstacles along the way, and there's a famous Stoic quote from Marcus Aurelius. Of course, I don't remember the exact words, but it basically says that the obstacle, the challenge, becomes the way. And so
hmm
these companies now are undergoing fundamental changes. So I think your thematic investing is ever more relevant nowadays, because we are undergoing very fast fundamental structural changes.
hmm
So I can't wait to go into each of your themes, and you give us your thoughts on what you see from your research of what's going on right now, and where do
Okay.
you think things are going? Because that's what we're here to pick your brain.
All
Um,
right. Sounds like we're doing the big talk,
yeah, we
the big work.
are. But before we get into all of that, I want to talk about your background, Chris.
hmm
It's very impressive. You have your MBA, you're a math nerd, it seems, just like me. And here we
Yeah,
are
yeah,
both,
yeah.
right? We are both into, contributing publications and writing. But how did you get into founding this thematic research and investing? How did you stumble upon this?
So I'll kind of give you the abbreviated version,
Okay.
sort of. So I in the early '90s, I got into equity research. You can credit Peter Lynch and One Up on Wall Street for that. That really kind of gave me the bug. And I got into the machinery capital goods practice at Solomon Brothers, which is long been acquired, um, and really started to understand through this gentleman that I was working with, for actually, that how to think about you know uh, cyclical industries. And then I wound up working also in the home building products industry. And then in equity research, you either move up, you move out. I eventually went down to a shop in Northern Virginia, Friedman Billings Ramsey, right around '98, when was anybody caring about industrial companies, cyclical companies, and all that? You remember the time? The answer is no. So a bunch of us in research got together and we kind of rebranded ourselves, and I wound up eventually covering the entire mobile phone ecosystem. Okay, so taking various learnings from different industries and seeing where I was going. But after a period of time, I got a little, burnt out, to be honest. I was traveling all over the place. I probably weighed, if we're showing the video, I weighed probably a good 20, 30 pounds more now than I do now. And I was not pleased. And there were some things that were happening as well on the research side, with the decoupling from investment banking that was making research not quite as fun place to be, right? Let's just leave it at that. But at the same time, as all that was happening, I was sitting back thinking, as a equity industry analyst, you're responsible for, depending on the industry, 15, 20, maybe 25 companies, all in this silo. And if you go back to my comments, about 1998, there are times when your sector is in favor and you're busy, and there are times when your sector is not. And when you're not, it's very painful, lonely, choose your words. So I was sitting back, but I noticed that things that I was seeing unfold in the sector that I was covering had ramifications in other areas. So I started thinking, wow, what's a better way to think about the world instead of this, vertical silo, right? Maybe we need to look across industries to see how certain changes, I didn't nail it yet to structural changes at that point. This was 2005 after all. How do these changes, these developments impact other areas? And that started to give rise to this thematic way of thinking. And it took a while for me to kind of really think about it because, like we were saying before, there are trends or fads, short-lived. So how do you really identify pronounced multi-year structural changes, right? It's not easy. There can be some false starts, and you have to know the data to look for to corroborate not only that it's unfolding, but that it's continuing to happen, right? So it took a long time for me to kind of develop that framework. And at the same time, as we're doing this, you want companies that have what we call high thematic purity. In other words, what companies have their business, revenue, profits really tied to these structural changes that you're talking about? All too often, and this is one of my pet peeves where I get my backup about thematics, is folks will talk about a company, company XYZ, it's really benefiting from this theme. I sit back and I go, really? Because last time I checked, according to the 10Q, the 10K, the financial documents that matter, or the company presentation, they've got maybe 15, 20% of their business exposed to that. Not really high thematic purity. So, but I apologize, as is going to happen. I'm going to pull you in a couple of different directions in my answers. So I think you were asking me, if I remember correctly, Ro, tell me more about this thematic framework, correct?
Sure, go for it. I mean, when you mention exactly what you just said, I think of Blockbuster, and I think about what happened to them,
Yes.
right?
Yes. So I mean,
Structural change in that.
That's it's let's do a little compare contrast, right? Because it's so timely that you bring this up, because as we're talking, Netflix recently reported their March quarter results, and they announced that they are finally winding down their DVD subscription business in the next several months. But who were they competing against? They totally ate the lunch of Blockbuster because they could not get out of their way, right? And but there was an interim company too, right? It was known as Redbox, right? So you could, before you would go into the grocery store, whether it's a Ralph's, a Harris Teeter, Kroger, what have you, what movie are we getting for the night? Put your money in, pop out a DVD. You got to bring it back in a couple days, fine. But both Blockbuster and Redbox tried to move into streaming, and it didn't work. They didn't understand the nature of the business model. And it's so important to identify the companies, and I think this is where you were going with it, is what companies can evolve their business models over time to the changing landscape. Not all can, not all can at all. And some that have done a great job in the past don't always continue doing it. I'll give you a great example, Nokia. Now, I know Nokia as, the early 90s as the market share leader, 46% market share of the global mobile phone market, 46%. I mean, these are like Coca-Cola numbers, right? So it may surprise you. Do you know how Nokia originally got started?
No, I don't.
Rubber and rubber boots.
Oh,
Yeah, and
not
they had a
technology
series
then.
of business. They had a series of businesses over previous decades, but they ultimately, through the vision of their management team, saw this mobile phone opportunity. But here's the thing: they went from 46% of the mobile phone market to pretty much no market share in the smartphone market.
Wow. Well, it's about diversifying, differentiating, adapting, innovating, and not all, like you said, not all companies are able to do that. They
Mhm.
seize that opportunity with the mobile phone, but unfortunately, maybe they just stagnated. Maybe they just rested on their laurels. You're
I
about to
think,
add something?
yeah, yes, I was. I think oftentimes companies get too comfortable,
Yes,
right?
exactly. Resting on their
So
laurels. Yeah.
so much so that it's Andy Grove, right? Only the paranoid survive, right? What's the next level of innovation that's going to disrupt my business? And Apple, if you think about it, it does a pretty good job
Hmm.
of innovating themselves out of older products, which is pretty interesting. Personally, I think companies would be smarter to disrupt themselves than risk being disrupted by somebody else.
Absolutely. I agree with that. I think that you need to, it's always, it comes back to your own life. You have to compare yourself against yourself. And, so you have to disrupt yourself. You have to see, hey, am I staying current? Am I innovating? Are we stagnating? These are all questions you have to ask. We've had one of our businesses, now it's going to be almost 25, no, 22, 23 years, something like that. And we've evolved many times. And one of our main technologies of disruptive in the industry. And we've had to keep, just redeveloping and adapting. And what we do is a bottoms up approach. We always study the market and then we go with the
Mhm.
demand. It's all based on demand. It's a bottoms up
Yeah.
approach. And the customer actually becomes part of the innovation process. So we know where things are moving. I'm not going to use the word trend. We know where things are, structurally moving into and what people are wanting and what type of industries are growing and other ones are dying and they're phasing out. And that's just part of the life cycle of the business and the economic cycles. We go through cycles and things are changing, they're evolving. And, people say, oh, there are going to be no jobs left with the way automation and, blockchain. And it's like untrue. You
Yeah.
need to think different. And that's the key. Just think differently, right?
So yeah, I mean, I always use that. Of course, I'm stealing it from Apple and their
Apple, but
wonderful
they
marketing
didn't get the
campaign.
trademark. And my websites
Uh,
think different with Rosanna. You know that, right?
oh no, I did see that, and I was going to bring
Yeah.
that up later. But so the
Uh-huh.
whole reason that we kind of lean into that you have to think different, just along the investing front.
Mm-hmm.
S&P Global puts these statistics out, and I'm going a little bit from memory, but it's 85 to 90% of most money managers underperform their benchmark.
Mm-hmm.
And we kind of always, when we think about that, well, if you're all tracking the same sectors, all mapping
Yeah.
yourselves to the
Yeah.
same things, it becomes very hard to outperform if you're thinking
Mm-hmm.
like everybody else. So you naturally have to think differently. And
Absolutely.
so we try to do that by really leaning into thematics.
I love it. Absolutely. I think that's great. So what I'd like to go through are the themes, and we can do an overlap with macro. So what we can do is instead of just talking about macro, we'll base it on your themes. So let's start with economics. And where are we in the economic cycle to you and your research?
Oh boy, that's a good question. So there's a lot, to that, right?
Absolutely.
So let's set the base, okay? So last I saw it for the March quarter, the Atlanta Fed has, I think, 2.5% GDP.
Mm-hmm.
People by this point were kind of, 6, 7 months ago, were concerned about, oh, the Fed is hiking rates, and we could have a recession, at this point.
Mm-hmm.
And when you look back, so far the consumer is holding up pretty well. The
Mm-hmm.
services side of the economy that we measure through the various PMIs from S&P Global and ISM still growing. Manufacturing is contracting a little bit.
Yes, it has been.
Uh,
Yes.
yeah, but yet the number of jobs continues to grow. And what's
Mm-hmm.
fascinating is, we can look at the ADP employment report, and the March one was a little weaker than expected, but still north of 100,000 jobs being created in the month of March. You look at the employment report that the Labor Department puts out, still good jobs. If I remember correctly, it was in line with expectations, but the household surveys showed a significant number of jobs being created in the month of March. So people are still finding jobs. And I think when you look at the unemployment rate, 3.5% down, right, compared to what it was in February, and still down year over year from March 2000 through 2022, sorry, it tells you that the market remains tight, that there's going to continue to be wage pressure, and people are continuing to find work. So these are all good things. A signal to me, at least for now, the economy doesn't look like it's going to roll over that cliff, right? We could potentially get a shallow recession. We'll see. But again, so far, it's holding up better than expected. Still have to contend with inflation. January, February, March of 2023, if you look at the core CPI numbers, really tight, 5.5 to 5.6%, didn't budge. So I do think we're going to have another round of at least one more rate hike from the Fed. Consensus, according to the Fed's latest economic projections, you get there, you hold through the end of the year. Now, the stock market doesn't see that. And I think at some point, we're going to see a settling out where I think that we've got, what do we have? I don't know when you're airing this. So upcoming, we have the April flash PMI, right? That'll give us the next look at the economy and inflation pressures. And then soon we have the March personal income and spending data, which also gives us the PCE price index, the preferred inflation metric of the Fed. So we'll have another look at inflation. So ahead of all of that, I just think I think the market is still pricing in 2 rate cuts between now and the end of the year. I don't think those are likely. And I think that's going to be a little bit of an issue for the economy, for the stock market, not so much the economy. But I do expect but I will say this, tighter credit, higher interest rates, they will ultimately put a drag on the economy. But let's remember, that is what the Fed wants, to get inflation back to 2%. And if you've read the March FOMC meeting minutes, in their forecast, they have baked in a modest recession. So this is kind of unfolding potentially to plan for the Fed. The question I think we have to contemplate is, what happens if there is no recession? If there is no recession, it means probably that inflation is hotter for longer. The Fed has to do more. So how do we, there's a game, I date myself with this. It's a game I played as a kid called Lunar Landing. And it was almost like asteroids, right? Except you had this ship flying along the edge of the moon. You had to navigate it down and then slowly land it. But the problem is, the closer you get to the surface, the greater gravity takes over. So you had to be really gentle in landing the aircraft, otherwise you explode. And that's my example. The Fed is going to have to be very careful in navigating this the longer this goes on.
Absolutely. It's a delicate balance for them. I also agree with many of those points. Regardless of when this airs, what we're going to do is we're going to take your approach, the thematic approach. We're going to look at from a bird's eye view. So to me, the macroeconomic environment hasn't really changed much over the past few months. The general theme has been persistently elevated inflation, rising core month over month. That number is still a plus, so it's still rising. Inflation's cumulative. And so, per Deutsche Bank, they say once inflation's over 5%, it can take up to a decade to bring it back down. So, there are a lot of challenges we have. Inflation is much higher than it's been for a very long time. We also have high debt, government spending like crazy, tighter credit, like you said. We have low growth. The money supply is reducing now. And I always talk about inflation being too much money, all that money printing, chasing scarce goods and services. So we'll see how that plays out. But This inflation is a challenge, and I also agree with you. I believe that there won't be any cuts this year. I don't see how it's possible with this very strong labor market that we still have, with, low unemployment, still more jobs. And so, and inflation elevated. And unless the data changes, because they say data dependence, we don't see any real changes occurring. I mean, there's been a deceleration in inflation. However, we don't see it significantly reducing. It's like you said, very sticky. We're still hanging around that 5 to 6% level. So we'll have to see in the next few months, but I think the market has gotten ahead of itself, too optimistic. Maybe it's a recency bias, but it's pricing in, some cuts. And so let's see what happens when, they awaken to see that there aren't any. And I also believe that if inflation were to come down drastically, then we probably have a severe recession. It's like they work, right? They work inversely. And it's like, inflation, if we don't have a recession, then we'll have elevated inflation. If inflation comes down, then we'll probably have some type of recession. So we'll have to see if they can balance the scale, like you said, and how it will be moving forward. Now, we know margins are compressed, higher costs of, debt and capital from higher rates. And I do believe it's higher for longer. And, we had free money, negative rates, which contributed to a lot of the issues we're having, like the banking crisis. And, earnings I believe we're amidst an earning recession, right? And so, there's a lot to factor in, right? What are your thoughts on that?
So just a couple things to sprinkle in, and then I'll talk about
Please
earnings.
sprinkle, yes.
So Fed Governor Williams, I think, said the other day, he doesn't see the Fed's 2% target till 2024.
Yeah.
That tells you that they have a long time horizon, a long path to get to this. But on the earnings front, I always track the consensus expectations, and I just remember, the AAP team and I were sitting around, and we were chatting. Well, not sitting around, zooming around, I guess. And we were looking at the consensus expectations for 2023 over 2022, and I don't see it. I don't see how we can get there. And you ticked off a number of factors. So I continue to think that as we're really starting to go through this March quarter earnings season, we're more likely to see downside risk.
Yes.
In terms of those expectations, those numbers will come down. But here's the thing, I'm already starting to look forward to 2024. And believe it or not,
As I might,
those expectations, I think it's the sourcing here is FactSet. They're saying that EPS for the S&P 500 basket should be up 11.5%. Now, why is that?
Why?
Yeah, exactly. So we're going to have we're going to have think of it this way. Almost this time last year, interest rates were closer to zero than not, right? Now we're closer to 5% than not. Okay. That will continue all the way through. We're going to have tighter credit as a result of the bank failures, and we're learning that probably even tighter credit will be tighter stress tests will be put on small and medium-sized banks, which means that they're going to tighten up further. Okay, fine. So where's the demand growth going to become from? How do we fuel things, if you will? So I just think that those expectations for 2024 already have to start coming down.
Exactly. I agree with you. This is so much fun talking about this, even though it's an unfortunate situation. But yes, it's the reality of the situation, and this will take time. I think that the demand will come down, and, we're going to have, even lower growth. So right now, margins are compressed, but that top number, the revenues, are being held up by inflation, higher prices. So inflation works both ways. So as that demand comes down and that top number comes down, however, you still have prices that are elevated. Even if inflation decelerates, those prices are still elevated. And being in business, go on, you want to say something? I was going to say in manufacturing, I'm noticing we have new fees as well. And
yes.
Right?
Yeah. So there are certain pockets of strength, I think, or certain pockets where these inflation pressures and prices put in place to combat them, particularly in packaged good companies. I think as as we see those inflation pressures come down, all of a sudden those pricing levers to recoup costs become margin levers going forward, right? So, if you look at, probably Coca-Cola, PepsiCo, great pricing last year. Procter & Gamble, I believe, was putting pricing in again in sometime in the first quarter. You look at Chipotle, I believe they raised their prices, on average 16 to 17% in 2022. But if you look at their basket of inputs, starting to fall.
Absolutely.
So all of a
Volume
sudden,
is down.
yeah, so prices are higher, prices they're charging are higher, their costs are starting to come down. Not all costs, to be fair. There are certain things like wages that they have to contend with.
Yes.
But just to bring our conversation all the way back, those higher minimum wages are going to foster the restaurant industry to adopt what you were talking about earlier, which is, of course, automation and robotics.
Absolutely. Absolutely. Great points. I love that discussion. I want to go into demographics. This is a great theme that you mentioned, and we talked a little bit about it before, about the remote worker and how populations, there's been a shift. And, with COVID, a lot of people moved out of these states, such as like New York and California, and they moved to other places. So how does this all factor in with your thematic investing?
So in that front, when the biggest demographic theme that we look at is relating to the aging of the population, right? And we talked about that a little while ago. But what you're talking about in terms of movement from states because of greater connectivity, that really pulls back into our digital infrastructure theme, right? Because to your point, the pandemic pulled forward a lot of different things, including the shift towards work from home, which we could not do, or work from anywhere, I guess. We could not do unless we had these robust networks, unless there are other apps and programs, Zoom, Teams, GoToMeeting, what have you, Dropbox, Box, iCloud, Google Cloud, Google.
Yes, exactly. They're all interrelated.
Yes. Well, but that's so one of the things, and I didn't talk about this earlier, but it's the great thing about thematic investing done right is there should be no shortage of confirmation points for what you're talking about. And I think you sent me a nice tweet, direct message about the recent thematic signals that we posted, which are ripped from the headlines, articles that just, confirm, reconfirm, speak to, offer insight for, call it what you will, are different themes. And anybody who's listening, you can sign up over at tematica.substack.com. That's really the platform that we use that for. And oh, hey, by the way, we just started this week, depending on when we're airing, we're doing a podcast tied to breaking down some of those articles relating to our themes. And in this most recent one, we did the luxury buying boom, consumer inflation fighters, and we touched a little bit on aging of the population.
Love that. Well, we're going to get to that aging of the population. And I love the point that you make about how, America, the US, they're heavier, people are unhealthy, but they're seeking alternative, healthier solutions.
They
so
are
that's another
living. Yes.
I love that, the cleaner living. So before we get into that, I just want to talk about the geopolitical. You put out a great tweet recently about China and how there's some strong numbers coming out of there. What are your thoughts on what's going on in China? And since they are one of the, we are, US and China are the top GDP output contributors. So it definitely has a strong effect to the world output. So tell us your thoughts on what you're seeing coming out of China.
Sure. So let me set the context for this. So you referenced Cocktail Investing, the book that I co-authored. And in it, we talk about the 4 economic horsemen that you really have to pay attention to. And you just named 2 of them, right? The US and China, without question, but also the Eurozone and then Japan. Those are the 4 big dogs. I had to have a fifth one to watch, it's going to be India because of what's unfolding there,
Yes,
and
yes.
their rising middle class, rising disposable income. In many respects, they're what China was 15, 20, 25 years ago in that regard. So in terms of China, if we look at the data, holy smokes, the reopening is happening. March retail sales were up, I think, 10%, stronger than expected, and up, significantly compared to February. So that reopening is happening, and people are out, they're traveling, they're buying, they continue to buy increasingly aspirational goods or affordable luxury or luxury. No surprise, when I first started paying attention to China, a while back, the argument was, oh, look at the shift from a rice-based diet to a protein-based diet.
Mm-hmm.
And as that economy has, for lack of a better term, westernized and become the great manufacturing hub that it is, you've seen rising disposable incomes there. And now they are, last report, I forget who told me this, China's minting the fastest number of millionaires anywhere on the planet. So what do these people do? They adopt an increasing Western perspective of,
Exactly. Going into more service-based economy as well.
services, goods, travel, experiences,
Mm-hmm.
or just personal care. So when you listen to the companies like LVMH or Burberry or a lot of the
Mm.
luxury goods,
Yes.
they have leaned into this and they're seeing the benefits now.
Yes, absolutely. Excellent points. We're completely in line with our thinking there. Now, talking about luxury goods, I'd like to know your thoughts on what is the consumer doing, in your opinion? Are they conserving? Are they splurging? Are they adding to credit card debt? What are you seeing?
So all of the above. So, again, luxury goods, the data that we just talked about has been very positive. And I think I want to say, I don't think it was Burberry, but there have been a couple that have talked about favorable demand in the US as
Mm-hmm.
well, because we continue to spend. However, there is data out that shows that US consumer credit card debt is quickly approaching $1 trillion. And when you think about that, you think of what our conversation was about interest rates a little earlier, it means that more money is going to be going towards debt service, pressuring disposable
Mm-hmm.
income. So we kind of have a yin and a yang here, right? So we have the luxury buying boom, because people will, continue to buy luxury products. There's a group of people that inflation doesn't affect them, but for
Mm-hmm.
others, it's how they kind of show that they've arrived, who they are, how they identify. Or as I was joking the other day with someone, can't be on TikTok with, Sears clothing. You got to have something nice. So there is something to that. But at the same time, you have a growing number of people that are living paycheck to paycheck, using credit cards. And I just saw I just saw some statistic out that people are now using buy now, pay later or BNPL to buy groceries.
Mm-hmm.
And
I
and
saw
and the
that.
the pushback to me was, well, maybe they're just really smart and arbitraging. And I don't want to be negative on my fellow American, but most BNPL is spread out over 4 months, right? So you have some time. So it tends to be for bigger ticket items. You're going to the grocery store on average a couple times a month. So I don't see how that, measure it out over 4 months really kind of plays into this. But that's just me. So I do think that, we've seen kind of we've read about this, and I think these themes kind of speak to it a little bit. The question of where is this middle class in the United
Mm-hmm.
States?
I was going
And,
to ask you that. Yeah.
so it's becoming harder and harder to find is kind of my answer. But, you do have a rising middle class in China. You have a rising middle class in India. So there
Mm-hmm.
are opportunities over there. And when you think of Apple opening its first store in India, if you think of how other companies have kind of leaned into the China and India markets for areas of growth where rising disposable income is, it makes a lot of sense. And again, here we're talking more consumer facing, consumer product, consumer packaged goods.
Absolutely. Yeah, there was an article, I think, on Bloomberg talking about how
Yes.
India is the next big investment, next big country to exhibit the most growth. And there are a lot of people, it's also very risky as well. So to go and invest in these emerging countries. So there's a lot to factor in, but yes, tell us.
Sorry,
Please sprinkle in some more.
yes. So there was another article on Bloomberg, and we talked about this in this initial Tematica Signals podcast, that if you look at the aging of the population, right, and you look out, there's a forecast, and we talked about it on the podcast, between 2020 and 2060, right? China actually sees a hefty decline in their worker population. But to your point about India, continues to grow.
Yeah.
And we think, just to give an example, companies who like to disrupt themselves, who have long-term planning, right? Apple, I distinctly remember Tim Cook before the pandemic on an earnings call singing the praises of the Indian economy because of its average age was young, rising disposable income, and several other factors. So it speaks to your point that there are certain companies that are evolving their forward view. They're not resting on their laurels, to quote you. They are looking to move where the spending is.
Exactly. Follow the demand. And that's
Yes.
what's key. Marketing, know your market. Timing is so critical, and following the demand. So I love how you make points about the changing demands due to the, structural changes that we have with disruptors, the digital infrastructure and everything like that. What I love about your thematic investing, it beats the market approach because it takes a more of a bird's eye view and it looks into the future, which is what investing is about. I mean, investing is basically you're making bets, I guess is the word in simple terms, on the future, and you're speculating.
Risk-adjusted bets.
Always about risk adjusted. And I have a whole discussion I want to talk to you about risk, because risk is number one. Risk management is number one. And that's the most important thing. And we always look at everything from the lens of risk. How much can I lose before how much can I make? And that's very important. A lot of people who aren't as seasoned, I guess, or experienced or time-wise as us, we've been around, and unfortunately not everyone sees it that way.
Yeah. So I mean, look, I was fortunate enough to train under some folks that were thinking about all of these things. So I learned from them, learned how when you're investing in an individual stock, let's say, you have to your point, a lot of people get enamored with the upside, right?
Yes.
But you always have to say, what is the downside? And what I try to do when triangulating for a new position, potential upside, potential downside, you really want to look at history, where the stocks have peaked in the past, a variety of different valuation metrics, PE, enterprise value to revenue, enterprise value to EBITDA, dividend yield, blah, 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 blah. And a lot of folks stop at the halfway mark. Oh, I can make this, but they don't ask, what am I risking? So whenever we talk about in the AAP portfolio a new position, I always try to give upside, downside, right? And the goal is you want to be entering a position when your net upside is not good, but compelling. So what do I mean by that? Just a simple example. Let's say company XYZ stock is trading at $10. Okay. I have upside to 12. Oh, 20%. 20% is big, bro. 20% is big. But I have downside to 8. Oh, wait. That's down 25%. So my net up is actually net down 5%. So, would I start to pay attention to it? Keep it in the bullpen, keep it on the radar screen. Yes. And if there's some data that comes out, whether it's competitors, industry, company specific, that says, hey, I can take that price target to 12, from 12 to 13 to 14. Okay, I can get more comfortable, more bullish, because I've got, 30 to 40% upside versus 25% down. Okay. What I really like it though is when I get a combination of that and the stock pulls back. because now I got even more upside with far less downside towards that $8. So if it goes from 10 to 9, I'm loving it. Not to quote McDonald's or anything, but I'm loving it. So, so that's what I tend to think about. But again, you know,
and there are another one, I have to sprinkle that in. McDonald's is now adapting to this healthier lifestyle, and I think they're reinventing their menu a little bit. That's what I read.
They
Can they
are.
ever shake that image of fast food?
You know, do you want them to? I mean, that's kind of the pushback there. To me, McDonald's, Chick-fil-A, I haven't been to Burger King in years, but you know, some of those Wendy's, those are what I call guilty pleasures. You don't have them that often, but they are to be enjoyed, along with chocolate, coffee, and a few other things.
Exactly. Even though they say chocolate is so healthy for you, has so many antioxidants, but there's also
flavonoids.
Right, yeah, but there's also metals in there. There's like cadmium and all the other metals that are found in there. So if you read about that part, it's like, okay, the cost benefit analysis, and that's how I think in life. And I'm like, okay, what does it cost me? What's the benefit? And
I cannot believe I come on your show, be a good pal, and you destroy chocolate for me like that.
Well, I love chocolate too, and I still eat it, but to say it's the super food that's gonna, you know, heal everything and make me super person, I no. And that's how they market. It's all about the marketing, right?
Yeah. But are you milk chocolate or dark chocolate?
Oh, dark all the way, like 70% minimum.
Yeah. 70% cacao with sea salt and almonds.
Love that. Oh my God, I love that. I just the other day I had sea salt on it and it was so good. I love, and almonds. I love almonds with that. So I guess we have the same taste in chocolate. You know, I look at CAPM, expected value, you know, you do cost benefit analysis, you know, you can go into the R multiple. It's always about risk. So, you know, we're ultimately thinking in bets, you know, and I have to quote Annie Duke in her book. But it's so true because there's bounded rationality and, you know, there's opaqueness. There are things that we don't see, that we don't even know are there. So when we make our decisions, you know, we also have bandwidth constraint, and there's so much information. We have to minimize the noise. And I believe your book talks about that.
Yes.
Right?
Yeah.
And
Well, what happens is, so a couple things. There is a tremendous amount of information, right? And you have to go from noise to signals, essentially.
exactly.
You need to understand in a particular, whether it's an industry or a company or even a stock, what is it that really pushes the needle, you know, on the industry, the business, what have you. And you want to identify those, because if you start looking at everything and you try to, you know, assess every outcome, every impact, every data point,
too much.
What happens is analysis paralysis. Right. And it becomes very difficult to do. So one of the tricks that I have found that's been very helpful to me is, and this is in the early stages of, you know, taking a look at a stock, is I'll actually draw out like a 2-3 year, sometimes longer, price chart. And I'll notice, like, you know, not day to day, week to week, but more over months. What are the big moves that have happened? And I'll go back and trace their press releases and industry events to what those catalysts were, good or bad. So I can identify and see what the market thinks is important for these particular stocks. So that's one way to do it. But
yeah.
But to your point, sorry, you do have to be aware that this is, as I always say, this is not crockpot investing, right? There's no fix it and forget it. Things are always evolving, kind of like a good drama. You know, there are a lot of twists, a lot of turns before you get to the end. So you always have to keep refreshing and rethinking.
Absolutely. It's about constantly self-correcting as you go, constantly adapting, tweaking, and improving. Taking in information, you're learning and you're growing and you're modifying as you go. And I always say, because I have a background in behavioral economics, decision sciences, and I always talk about, you know, decision. There's a great book by Barry Schwartz, and he wrote about too many options, and we get that, you know, paralysis, like you said. So I always go by being a satisfier, it's called, or good enough. And, it's the people that try to maximize everything, and, perfectionism steps in as well, that you'll be stuck trying to make the decision. And in the end, you actually don't make the better decision. So there's, like you said, you have to filter out and you take what you think is most important, and you have to have that attitude of, this is enough, it's good enough.
Yeah,
And
well, I run into that every time I go to the grocery store and I stare at the milk, the
there's too many
multiple
of them.
cases of milks.
And the
Yes.
eggs, and yeah, there's just too much choice nowadays. Our goal is ultimately to improve the accuracy of our judgments in order to maximize the expected value of our choices. And that's the
Yeah.
whole framework of decision making. So it's just very important to know how to get those signals. So I want to ask you, I know your experience, you've been doing this for a while, and you probably execute, expertise-based, intuitive decision-making, but what are some signals to you that stand out, and that the other is noise?
Wow, that's a good question. I hate to say this, but it's almost like riding a bicycle. I kind of take it
Yes.
I kind of take it for granted, right? So, I mean, if I had to sit down and explain how to ride a bicycle, I don't know that I could do that. So let me say, for signals, it's knowing the themes the way I do, because I've helped craft them and
Yes.
debate them,
Yes.
and that's the key thing, right? So you need to have, well, if I develop these themes in a vacuum, i.e., just Chris in four walls talking to himself, there would probably be some mistakes. I'd be missing something. So instead, what I try to do is really use my partners and really bounce ideas off them, so we can have a constructive, um, argument. Let's say, no, this shouldn't. What about this? You're wrong here. Because then you either have to prove it or defend it, right? So it helps make things stronger. And in the part of doing that, you really collect a lot of data points. So for me, that's helped me kind of go on. Again, I don't want to say autopilot, but when I do a constant amount of reading, looking at presentations and things like that, I can quickly glance at something and kind of filter in or filter out if it's important or not. But it's also interesting listening to other folks and hearing what they think might be important, because when you have to explain to them why it's not, it's the opposite of what I just described. It helps you crystallize but it crystallizes your argument, sorry, as well. So I would say, for anybody who's looking for like some recent examples of great signals, head on over to tematica.substack.com, take a look at all the different thematic signals that are there. And they can come in a lot of forms. They can come in, videos on YouTube that are talking about either new products or industry developments, conversations with management teams, which we share there, or just articles just like you and I were talking about a couple minutes ago, with some articles on Bloomberg. But there's no shortage of these things. And what I found is that when you put the herd view behind, and you go, as I like to say, a view askew, and you start to think thematically, it's amazing what you will see.
Absolutely. Excellent points. You touched upon a topic that I write and I study about. It's called expertise-based intuitive decision-making, how it just feels right. You just know it. It's because you're an expert in that field, and it's pattern matching. And you're basically matching those patterns against recognizable prototypes in your head. You can't explain it. It's an implicit, tacit knowledge that you've gained from going through the deliberate practice and studying your fields of expertise. And that can only be imparted by someone following your motions and mimicking you, or being mentored by you. And it's not something that can be taught in a textbook, or directly through a lecture. It's a very interesting phenomenon that goes on. So thank you so much for sharing what's in your mind. Very
Well,
fascinating.
I will say that in two places, in cocktail invest, well, three places actually. In cocktail investing, we did our best at the time to try and lay some of that out for folks. We also had a pretty good resource in
It's a
there with,
great
I think,
book.
which I think was, if I remember the chapter, I can't remember the chapter number, but it was effectively like 11 or 13 questions you have to ask before you buy a stock. It included with that conversation on risk and reward that we had. So that's one place. The other is I'm since I became lead portfolio manager of Action Alerts Plus at the Street, we are bringing more and more of that thematic framework in, sharing signals and our thematic rationale for positions. So folks can certainly check it out there. And then the other one is just check out thematic signals, because that's where we share, all the different supporting signals for our themes. And we're, if you look down at the bottom, you'll see some other stuff that's down there as well, including some indices that we've developed for some partners in Europe regarding ETFs. And we've got a couple other things that we're working on with hopeful some new US partners.
Well, you'll have to keep us posted.
Happy to do it.
Yeah, you also mentioned something else that's very important in your process, which I find very valuable and rewarding. You go to non-stakeholders and you ask their opinion when making decisions, and that's key. Overconfidence is the mother of all biases. So, and when we make decisions, we are affected by biases and heuristics. So you get others' opinions on something. That's really a great process. I think you have an excellent product, Chris. And, I love the thematic investing theme. So what I want to wrap up with is the question of the day.
The burning question.
The burning one. It's on fire. Okay. Aging of the population. We discussed more seniors. People are more focused on healthy lifestyle. We have a new middle class emerging with new demands, safety and security, and remote work. And I
see what you're doing. You're weaving through all these themes. I see it.
I'm a big bull in cybersecurity. I think that's a very important, necessary sector. And I didn't mention that earlier, but I wanted to mention it. Then we have rebuilding America, infrastructures, a digital infrastructure, guilty pleasures, like you mentioned, living the life, all of those excellent research that you've done. Take all those factors, put them in a little spinner or something. Yeah. What kind of readout do you get? What industries, what sectors are you looking at for the future?
Let me, before we get out, I should probably do this. Folks who know me well know I'm probably can anticipate what I'm about to say. But I will say here, I've said it before, I'll say it again. Sector investing is dead. So so think about it, right?
I agree. I love that you said that.
It's I wanted us to get, sector investing is dead on the front, and
we should get shirts and hats.
On the back. Yeah. Exactly. Maybe I don't know about hats.
Maybe in a tattoo too, right?
No, I already got one. If I got another one, some people would kill me. So anyway, not that I'm against people who have multiple tattoos or whatever. So let's see, because that is kind of a big question, right? So I do think if you look at all of those, are there opportunities in each of them? Yes, either for businesses to capitalize on those investment themes, 100%, or investors identifying the right companies positioned to prosper from those themes, 100%. That's partly why we're using it over at actionalertsplus.com. That's why we were able to build some thematic models for our partners and thematic baskets for other partners, and capitalize on them in ETFs with our partners, some of our partners in Europe. You're always looking for, to your point, where the demand is, where the growth is, where the opportunity is. It's an iterative thing. If we were to simply sit back and say, oh, this industry, like tech, okay, tech is like, it's so big, I'm going out of the frame, right? Are we talking about, PC, smartphones, IoT, data center, software, right? And other areas of that, display technologies. There is a whole host of display technologies that are out there. So you really have to understand how to identify. And ultimately, that's what Thematics is helping us do. It's identifying, again, those structural changes, and allows us to think about ways, companies, or what have you, to really capitalize on that, to go, as you said so eloquently, where the demand is.
Absolutely. Thank you so much, Chris. Fantastic time I've had with you today. Can you please share with us how people can find you and the services
Sure.
that you offer for people? Because this thematic investing is brilliant. I love it. It's absolutely amazing. So I'm sure many will want to find out more about it.
So the socials, I'm looking at it right now, at Chris J. Versace on Twitter. You can subscribe to actionalertsplus.com. That's probably one of the best ways, because I put out a tremendous amount of content there, including the AAP podcast. And then if you want, just do yourself a favor, head on over to Tematica@substack.com, drop your name in. You'll be put on an automatic list whenever we publish Thematic Signals, including that new Thematic Signals podcast that we just started.
Awesome. Thank you so much. Are you into fashion by any chance with that name Versace?
Are you asking that because of my last name?
Yes. Any relation? No.
You know, I would like, so the truth of the story is
Ooh,
that
there's a story? There's a story here?
No. So I would get asked that all the time, right? And people would say, like, I would go into restaurants or hotels or whatever. Oh, are you related? Are you related? And I would say, are we talking reservations here? Then yes, I am.
Yeah.
But no, actually, the truth be told is that my grandfather, there is a connection with the Versace,
Ooh.
but it's so distant that, as I joke, I too pay $4 at Starbucks. It's not enough to really mean anything, at least in my opinion. But hey, if my Italian brethren want to hunt me down and talk all about thematic investing, happy to do it.
Thank you so much. Such a wonderful time. And thank you so much for taking the time in your very busy schedule to speak with us. Thank you.
Happy to do it. Happy to do it. Happy to do it again.
Absolutely. And we will. Thank you. Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon. All investment, real estate, financial, legal, and tax opinions expressed by Rosanna Prestia or on The Rose Show should not be relied upon as professional advice and are intended to be used for informational purposes only.